Welcome to the Deep Dive. Today, we are immersing ourselves in the Q3 2025 earnings call for HCI Group. The call took place right after the market closed on November 6th.
And, for anyone following this space, this is an essential one to unpack because the results created this immediate and massive conflict.
A real paradox. On one hand, you have these incredible results. On the other, the market reacts, well, pretty negatively.
Exactly. You had phenomenal profitability, some of the best you'll see in the industry, and then almost immediately a sharp sell-off in the stock. So our mission today is really to analyze why. Why did the market focus on the small shadows instead of the blinding light of that financial beat?
We'll be walking through the commentary from the management team CEO Paresh Patel, COO Corinne Coleman, and CFO Mark Harmsworth. They laid out a story that was all about strategic transformation.
But clearly the market needed a little more convincing. So let's just start with the headline figures to frame this whole conflict.
Okay, the bottom line. It was frankly a blowout. HCI reported diluted GAAP EPS of $4.90.
Which just utterly crushed the consensus estimate. I mean, S&P Global had it pegged at what, 281?
$2.81. So that's a staggering 74% beat. And to put that growth in perspective, it's up from just 52 cents in the same quarter last year.
Those are just massive numbers. That kind of beat is rare, and it usually sends a stock soaring. It suggests the company found a gear that analysts, they just didn't see coming.
But here's the catch, the fly in the ointment, revenue.
Right, the top line.
Total revenue came in at about $216 million. Now, that was up strongly year over year, but it missed the consensus target.
Missed it by about 1.6%. The target was $220 million.
So investors were left with this riddle. Do you reward the extraordinary profit, or do you punish a slight miss on revenue?
And the market answered that question very, very quickly, didn't it?
It did. The stock dropped nearly 7%. And the volume shot up, suggesting a really rapid repositioning. Investors chose to focus on that revenue signal and, I guess, the questions around the margins.
Okay, so let's dig into what actually drove that incredible EPS beat, because this is where the bullish side of the argument really finds its footing. It all came down to underwriting. Underwriting
success that was almost, unbelievable.
I think that's fair to say. Management reported a net combined ratio of just 64%.
64. Okay, for anyone who doesn't track P&C insurance daily, remind us what that means.
So the combined ratio is your measure of underwriting health. It's your expenses plus your losses divided by the premiums you earned. Anything under 100% means you're making a profit just from selling insurance, even before you make a dime on investments.
And 64% isn't just under 100. That's a huge victory.
It is nearly unheard of, especially for a carrier that operates so much in the Florida market. Analysts were expecting something closer to 82%. Management even called it industry leading.
So what was the secret sauce here? Was it cost cutting, or was it just a really good quarter for claims?
It was overwhelmingly on the claims side. The loss ratio. The gross loss ratio came in at an astonishing 22%.
22. And how does that compare to last year?
Well, last year was about 39.8%, but that was impacted by Hurricane Helene. Even if you adjust for that, last year's adjusted figure was 25%. So they still improved from 25 down to 22.
Okay, let's pause right there. Let's bring in the skepticism. A 22% loss ratio is incredible, but how much of that is just luck? Benign weather.
And that is the absolute critical debate. Management was very measured on this point. They acknowledged that, yes, structural improvements from their tech are helping, but that this exceptionally low number also reflects good weather.
So they basically warned that this might not be repeatable every single quarter.
They did, explicitly.
Yeah.
So the big question for the market becomes, can they keep the combined ratio under 80%, which is their goal, if that loss ratio normalizes? That's the risk that spooked people.
Right. But what about the other side of the ratio? The expenses. That's where you'd see the structural argument.
Exactly. And that side of the story is very solid. The expense ratio was low at 30%. What's really fascinating is the efficiency. The CFO noted they grew gross premiums earned by over 13% year over year.
While keeping operating expenses
essentially flat. They credited their technology, their operational leverage, and they said they did it without really adding any people.
That structural efficiency is the perfect pivot to their biggest strategic news of the quarter. The unlocking of the value in their technology arm, Exzeo.
Yes, this was the defining event. The subsidiary, Exzeo Group, completed its IPO at $21 a share. They raised a lot of capital, about $155 million net.
And the crucial part is that HCI, the parent company, didn't sell a single share.
Not one. They still own about 81.5%. That's 75 million shares. And the capital impact, even without selling, is projected to be huge.
What are the numbers on that?
Management projected the IPO will add about $125 million to HCI's consolidated book value and about $10 to the book value per share in Q4.
A $10 per share lift. That is massive. Their book value per share was already up over 50% this year to around $63.
And this lift is expected to push their consolidated equity over $1 billion and get that book value per share, in their words, close to $80 by the end of the year.
Okay, but here's where it gets really interesting. The accounting for that stake.
This is the shocking part. The CFO stated that those 75 million shares they still own, they were recorded on HCI's books at less than $3 per share, their original cost.
Wait, hold on. So the market just valued this asset at $21 a share in an IPO, but HCI is carrying it on its books for a fraction of that.
Precisely. It means there is a gigantic unrealized gain that isn't reflected in their current stock price. The CFO even pointed out that this unrealized gain is more than the entire book value of HCI before the IPO.
That is the definition of a hidden asset, just waiting to be unlocked.
It gives the parent company incredible optionality, incredible collateral strength.
But let me play devil's advocate here.
Yeah.
The market is often skeptical of these tech spin-offs from, slower growth legacy companies. How durable is that $21 IPO price?
And that's absolutely part of the pullback. The initial reaction suggests investors are still valuing HCI as an insurance company that uses some tech, not a tech company that happens to own an insurer. It's a battle over identity.
Okay, so let's look at the core insurance business. What moves did they make to strengthen it?
Well, on the growth front, they showed really strong execution in Florida. In October, they assumed over 47,000 policies from Florida citizens.
And that represents a lot of premium.
About $175 million of in-force premium. It's substantial, deliberate growth.
But then they immediately paired that with a show of discipline. They announced they would not participate in the December Citizens takeout round.
And that move is really telling. Management said they're focusing on underwriting quality, on integrating those new policies. The CEO even suggested the Citizens well is, and I quote, dried up that much, implying the quality of policies wasn't there.
So a shift from pure volume to quality. What about the balance sheet? Any moves there?
Yes, two really key actions. First, they doubled their revolving credit facility with Fifth Third Bank from $75 to $150 million, and they managed to release the real estate collateral that was securing it.
Which frees up assets and gives them a lot more liquidity.
Exactly. Holding company liquidity is strong, around $285 million. And second, they converted some debt, the 4.75% convertible notes.
Sounds technical, but what does that mean in real dollars?
It means serious savings. This move cut their quarterly interest expense from $3.4 million down to just $1 million. That's a saving of $2.4 million every single quarter. Huge.
So putting this all together, the great combined ratio, the BVPS boost, the debt reduction, what was the overall message from management?
Well, they didn't give formal numeric guidance, but the key themes were clear. Sustain a sub-80 combined ratio, leverage Exzeo, and hit that $80 book value per share target. Their focus is on compounding book value, not obsessing over short-term revenue numbers.
Which brings us right back to the market reaction. If the story is so positive, why the pullback? Why the skepticism?
You have to consider the context. The stock had an incredible run leading into this report, up over 50% year to date, so expectations were very, very high.
And the main concerns were what? The revenue miss and the weather.
Exactly. It's a classic debate between the structural story and the cyclical one. The structural story is Exzeo's value and the new efficiency. The cyclical concern is that revenue is slowing and the weather luck will run out.
And we saw this tension reflected in the analyst coverage, right? Oppenheimer downgraded the stock.
They did, to market perform. Their argument was essentially that the valuation already reflected too much optimism. They felt the risk of weather normalization wasn't fully priced in, making the stock fully valued near $200.
But on the other side, you had a firm like Compass Point maintaining a buy rating.
They did, and they were likely focused on that $80 BVPS target, the balance sheet strength, and the sheer optionality from that undervalued Exzeo stake. It's a complex story. You have to decide if you trust the balance sheet or fear the weather cycle.
One last thing on Exzeo. Management changed how they're going to communicate about it, which is important for investors.
Yes, a critical change. They clarify that going forward, Exzeo will hold its own separate earnings calls. So HCI will talk about their ownership.
Yeah.
But for details on the tech pipeline and growth, you have to listen to Exzeo's call.
It adds transparency, but also complexity for anyone trying to model the combined company.
Right, which might cause some investors to just hit the pause button for a bit.
All right, let's move into our segment where we explore the outrageous but plausible ideas based on the tension in this call. This is not financial advice segment.
Okay, so if we were to design a trade idea here, it would focus squarely on that massive disconnect we talked about, the gap between the accounting value and the market reality of their assets.
The ultimate value paradox trade. So what's the thesis?
The thesis is a long position in HCI. You're betting that the market's obsession with the tiny revenue miss and the short-term weather cycle is temporary. The edge is believing that the market will eventually be forced to recognize the true value of those 75 million Exzeo shares, which are still sitting on the books for less than $3 a share.
So it's a bet on management hitting that $80 book value target, and that the capital strength from Exzeo acts as a kind of safety net and a long-term catalyst.
Precisely. If they prove the underwriting improvements are structural by keeping the combined ratio under 80, and they hit that $80 BVPS target, the current stock price looks fundamentally misaligned. The trade is a bet that this hidden tech asset gets recognized, justifying a re-rating far above all the current cyclical noise.
So to wrap it all up, HCI delivered truly exceptional Q3 profitability, powered by those low loss ratios, and they made huge strides on capital management with the Exzeo IPO.
The takeaway is the enormous progress on capital flexibility and that $80 BVPS target. Their value is now built on both stable insurance assets and a publicly valued high-growth tech platform.
But the critical debate for you, the investor, remains the durability of that low combined ratio and whether that slight revenue miss signals any long-term slowing in their core business.
And that raises our final provocative thought for you to think about. When a company is on track to hit $80 in book value per share, does the market fully appreciate that this book value is now built on two fundamentally different asset classes, insurance and tech? Is this stock drop just some necessary profit-taking after a huge run, or is it genuine disbelief in the long-term value of that Exzeo spinoff?
Something to mull over as you recalibrate your models. Thank you for joining us for this deep dive into the HCI Group Q3 2025 earnings call.